CRISPR Therapeutics, CRSP, Stock Analysis, May 2025 Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a financial advisor before making investment decisions. Introduction: CRISPR Therapeutics AG, Nasdaq, CRSP, stands at the forefront of gene editing technology, leveraging CRISPR/Cas9 to develop transformative therapies for serious diseases. As of May 2025, CRSP's stock price is $36.86, reflecting a market capitalization of approximately $2.92 billion. This analysis delves into CRISPR Therapeutics' financial performance, pipeline developments, market position, and future prospects. Financial performance: in 2024, CRISPR Therapeutics reported a significant decline in revenue to $37.31 million, down from $371.21 million in 2023. This sharp decrease is attributed to the delayed commercialization of its gene therapies, notably Casgevy, and the inherent complexities of gene editing treatments. Despite the revenue downturn, the company maintains a robust financial position with approximately $1.9 billion in cash reserves, ensuring operational continuity and funding for ongoing and upcoming clinical trials. Casgevy, a milestone in gene therapy. Casgevy, exagamglogene autotemcel, is the first CRISPR-based gene editing therapy approved by the US FDA, marking a significant achievement for CRISPR Therapeutics. Developed in collaboration with Vertex Pharmaceuticals, Casgevy targets sickle cell disease, SCD, and transfusion-dependent beta thalassemia, TDT, offering potential long-term relief for patients by editing stem cells to produce healthy hemoglobin. The approval of Casgevy in late 2023 and early 2024 in the US and Europe has positioned CRISPR Therapeutics as a pioneer in the gene editing space. However, the therapy's complex administration process, including stem cell collection, gene editing, and patient infusion, has led to a gradual rollout and adoption. Expanding pipeline and clinical trials: CRISPR Therapeutics' pipeline extends beyond Casgevy, with several promising candidates in various stages of development. CTX310, a gene editing therapy targeting ANGPTL3 to reduce LDL cholesterol levels. Early phase 1 data indicates significant reductions in triglycerides and LDL cholesterol, with peak reductions of up to 82% and 81%, respectively. CTX320, another gene editing therapy aimed at cardiovascular diseases, currently in early clinical stages. CTX112 and CTX131, next-generation CAR T-cell therapies targeting B-cell malignancies and solid tumors, respectively. Preliminary results from CTX112 have shown strong efficacy and a tolerable safety profile, with updates expected in mid-2025. These developments underscore CRISPR Therapeutics' commitment to expanding its therapeutic reach and addressing a broad spectrum of diseases. Market position and competitive landscape: CRISPR Therapeutics operates in a competitive biotech environment, with several companies pursuing gene editing technologies. Notably, Verve Therapeutics is developing a one-time CRISPR-based therapy targeting PCSK9 to reduce LDL cholesterol levels, offering a potential alternative to traditional treatments. While CRISPR Therapeutics faces competition, its early achievements, such as the approval of Casgevy, provide a strong foundation for future growth. The company's strategic collaborations, particularly with Vertex Pharmaceuticals, enhance its development capabilities and market presence. Analyst perspectives and stock outlook: analysts maintain a positive outlook on CRISPR Therapeutics, with an average 12-month price target of $74.35, suggesting a potential upside of over 100% from current levels. This optimism is driven by the anticipated commercialization of Casgevy, advancements in the company's pipeline, and its strong financial position. However, the stock has experienced volatility, with a 47.65% decline year-to-date as of March 2025. Investors should be mindful of the inherent risks associated with biotech investments, including regulatory hurdles, clinical trial outcomes, and market dynamics. Conclusion: CRISPR Therapeutics stands as a trailblazer in the gene editing field, with significant milestones such as the approval of Casgevy and a promising pipeline of therapies. While challenges remain, the company's innovative approach and strategic partnerships position it well for future growth. Investors should consider the potential rewards in the context of the associated risks and conduct thorough research before making investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a financial advisor before making investment decisions. EQT Corporation, NYSE, EQT, Stock Analysis, May 2025. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Introduction: EQT Corporation, headquartered in Pittsburgh, Pennsylvania, stands as the largest natural gas producer in the United States, primarily operating within the Appalachian Basin. As of 2024, the company reported production of 6.088 billion cubic feet of natural gas equivalent per day and holds approximately 19.8 trillion cubic feet equivalent of proved reserves, predominantly in the Marcellus Formation. This analysis delves into EQT's recent financial performance, strategic initiatives, and market outlook to provide a comprehensive understanding of its investment potential. Financial performance and outlook. In 2024, EQT achieved a revenue of $5.04 billion, marking a 1.36% increase from the previous year. The company's net income stood at $231 million, with an operating income of $685 million. Looking ahead, EQT has set its 2025 production guidance between 2,175 and 2,275 billion cubic feet equivalent, reflecting an increase of 125 percent over prior expectations. This optimistic outlook is attributed to strong well performance and the benefits derived from compression investments. Capital expenditure plans for 2025 include maintenance capital of $1.95 to $2.12 billion and growth capital of $350 to $380 million. The company anticipates generating approximately $2.6 billion in free cash flow for 2025, with a projected net debt of around $7 billion by year-end, ahead of its $7.5 billion debt target. Strategic initiatives and acquisitions. EQT has been proactive in enhancing its operational efficiency and expanding its asset base through strategic acquisitions. Notably, the company completed a $5.45 billion acquisition of Equitrans Midstream and a $1.8 billion deal for Olympus Energy's assets. These acquisitions are expected to bolster EQT's infrastructure and positioning in the growing liquefied natural gas (LNG) market. Furthermore, EQT has undertaken debt reduction initiatives, including the redemption of all outstanding 6.125% senior notes due 2025 for a total cash payment of $616.3 million, demonstrating its commitment to strengthening its balance sheet. Market position and analyst perspectives. As of May 9, 2025, EQT's stock price stood at $55.62, reflecting a 4.16% increase for the day. Analyst consensus rates the stock as a buy, with a 12-month average price target of $56.24, suggesting a modest upside from the current price. The company's strong fundamentals, including a high IBD composite rating of 93 and an earnings per share rating of 97, further reinforce its positive outlook. Wall Street projects EQT's earnings to surge by 112% in 2025 and 45% in 2026, driven by favorable macroeconomic conditions and increased demand for natural gas, particularly in sectors like artificial intelligence and data centers. Risks and considerations. Investors should be cognizant of several risks associated with EQT's operations. Commodity price volatility. As a natural gas producer, EQT's revenue is susceptible to fluctuations in commodity prices, which can be influenced by global supply and demand dynamics. Regulatory environment. Changes in environmental regulations and energy policies could impact EQT's operations and profitability. Operational risks. Challenges related to drilling, transportation, and infrastructure could affect production levels and cost efficiency. Market competition. The energy sector is highly competitive, and EQT faces competition from other producers in the Appalachian Basin and beyond. Conclusion. EQT Corporation presents a compelling investment opportunity within the energy sector, underpinned by its position as the largest natural gas producer in the U.S., robust financial performance, and strategic growth initiatives. However, potential investors should carefully consider the associated risks and conduct thorough due diligence before making investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Toronto Dominion Bank, NYSE, TD, Stock Analysis, May 2025. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Introduction: Toronto Dominion Bank, TD, stands as one of Canada's largest and most influential financial institutions, with a significant presence in both Canadian and US markets. As of May 2025, TD's stock is trading at approximately $67.70 per share, reflecting a market capitalization of around $93.6 billion. This analysis delves into TD's recent financial performance, strategic initiatives, regulatory challenges, and market outlook to provide a comprehensive understanding of its investment potential. Financial performance: the second quarter of fiscal 2025, TD reported a substantial increase in net income, driven primarily by the early quarter sale of its 10% stake in Charles Schwab for $21 billion Canadian dollars. This sale contributed an $8.57 billion Canadian dollars gain, boosting overall net income to $11.13 billion Canadian dollars, up from $2.56 billion Canadian dollars the previous year. Adjusted earnings per share were $1 Canadian dollar and 97 cents, surpassing analyst expectations of $1 Canadian dollar and 76 cents. Total revenue rose 66% to $22.94 billion Canadian dollars, with net interest income growing to $8.13 billion Canadian dollars and non-interest income more than doubling to $14.81 billion Canadian dollars. However, TD increased its loan loss provisions to $1.34 billion Canadian dollars, up from $1.07 billion Canadian dollars last year, reflecting caution amid economic uncertainty. The bank anticipates economic challenges due to global trade tensions and US tariffs, projecting a shallow recession and rising unemployment in Canada. Under new CEO Raymond Chun, TD is undergoing a strategic review after a $3.09 billion anti-money laundering settlement. Despite these headwinds, TD maintained a strong capital position with a Common Equity Tier 1 ratio of 14.9%, surpassing regulatory requirements. Strategic initiatives and leadership transition: in September 2024, TD's CEO Bharat Masrani announced his intention to retire after 38 years at the bank. His retirement was accelerated to February 1, 2025, with Raymond Chun appointed as the new CEO. Chun's leadership marks a new chapter for TD, focusing on operational efficiency and addressing past regulatory challenges. The bank is conducting a strategic review to simplify operations and explore new growth opportunities. Regulatory challenges and compliance measures: in October 2024, TD Bank agreed to a historic $3 billion settlement with US regulators over anti-money laundering violations. This settlement included a record-breaking $1.3 billion penalty from the US Treasury Department's Financial Crimes Enforcement Network, FinCEN. Additionally, TD is under an asset cap imposed by US authorities, requiring a 10% reduction in its US assets, including the divestment of up to $50 billion of low-yielding bonds. These measures aim to ensure compliance but may impact short-term revenue streams. Market outlook and analyst perspectives: despite regulatory challenges, TD's stock has shown resilience. As of April 30, 2025, TD stock is trading at $87 Canadian dollars and 26 cents on the Toronto Stock Exchange, near its 52-week high of $87 Canadian dollars and 99 cents. Over a one-year period, the share price is up 6.73%, outpacing several North American peers. Jefferies upgraded TD's stock rating from hold to buy in December 2024, citing improved valuation and potential for capital appreciation. Dividend policy and capital allocation: TD has a strong commitment to rewarding its shareholders. The bank declared a forward annual dividend of $4.08 per share, yielding approximately 5.12%. The payout ratio stands at a high of 93.06%, reflecting TD's focus on maintaining its reputation as a reliable dividend payer. Despite the regulatory challenges, TD has continued to prioritize shareholder returns. Risks and considerations. Investors should be aware of several risks associated with TD's operations: regulatory scrutiny. The $3 billion settlement and asset cap imposed by U.S. regulators could impact TD's operations and profitability in the U.S. market. Economic uncertainty, global trade tensions and rising interest rates may affect TD's loan portfolio and credit quality. Operational challenges. The ongoing strategic review and leadership transition could lead to operational disruptions in the short term. Conclusion. Toronto-Dominion Bank remains a significant player in the North American banking sector. While recent regulatory challenges have impacted its operations, the bank's strong financial performance, strategic initiatives, and commitment to shareholder returns position it well for future growth. Investors should consider the potential risks and rewards associated with TD's stock and conduct thorough research before making investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. TripAdvisor Incorporated, Nasdaq, TRIP, Stock Analysis, May 2025. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Introduction. TripAdvisor Incorporated, Nasdaq, TRIP, is a leading online travel platform that provides reviews and booking services for various travel-related content, including hotels, restaurants, and experiences. As of May 2025, the company is navigating a complex landscape characterized by evolving consumer behavior, regulatory challenges, and competitive pressures. This analysis examines TripAdvisor's recent financial performance, strategic initiatives, and market outlook to provide a comprehensive understanding of its investment potential. Financial performance. In the first quarter of 2025, TripAdvisor reported a revenue of $411 million, marking a 5% increase year-over-year. The company's adjusted EBITDA stood at $73 million, representing 18% of revenue. Despite this growth, the company faced challenges, including a 6% increase in marketing costs and a 41% reduction in general and administrative expenses. Operating cash flow was positive at $102 million, while free cash flow amounted to $83 million. For the second quarter of 2025, TripAdvisor projects revenue growth between 5% and 8%. The company anticipates mid-teens growth in the number of experiences booked through its Viator platform and revenue growth of approximately 9% to 11%. The Fork, another key platform, is expected to see revenue growth in the range of 26% to 28%, including a currency benefit at current rates. However, the brand TripAdvisor segment is projected to experience a flat to 2% decline in year-over-year revenue. Strategic initiatives and brand transformation. TripAdvisor has been undergoing a strategic transformation, shifting its focus from a hotel meta search engine to a comprehensive travel planning platform. This transition involves enhancing its experiences and dining platforms, Viator and The Fork, which have shown strong growth. In 2024, Viator's revenue increased by 16%, while The Fork's revenue grew by 23%. Together, these platforms contributed 56% of the company's total revenue, up from 50% in 2023. Despite these gains, the brand TripAdvisor segment experienced an 8% decline in revenue in 2024. The company attributes this to tough pricing comparisons and foreign exchange headwinds. Management expects growth to be backloaded in 2025, with acceleration anticipated in the second half of the year. Market outlook and analyst perspectives. The online travel industry faces a challenging environment in 2025, with analysts expressing caution. A consensus rating of reduce has been assigned to TripAdvisor by 14 brokerages, with 3 analysts recommending a sell, 9 suggesting a hold, and 2 advising a buy. The average 12-month price target among analysts is $17.50, indicating limited upside from the current stock price. Factors contributing to this cautious outlook include the normalization of travel demand post-pandemic, rising interest rates, and potential economic slowdowns. While platforms like Viator and The Fork continue to grow, the overall market dynamics pose challenges to sustained revenue growth. Risks and considerations. Investors should be aware of several risks associated with TripAdvisor's operations. Economic sensitivity. The company's performance is closely tied to consumer spending on travel, which can be affected by economic downturns and geopolitical events. Regulatory challenges. Changes in data privacy laws and regulations in key markets could impact TripAdvisor's ability to operate effectively. Competitive pressures. The online travel industry is highly competitive, with players like Booking Holdings, Expedia, and Airbnb vying for market share. Execution risks. The success of TripAdvisor's strategic transformation depends on effective execution, particularly in integrating and scaling its experiences and dining platforms. Conclusion. TripAdvisor Incorporated is at a pivotal juncture in its evolution, transitioning from a hotel meta search engine to a broader travel planning platform. While platforms like Viator and The Fork show promise, the company faces challenges in its core brand TripAdvisor segment and broader market dynamics. Investors should consider these factors and conduct thorough research before making investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Lyft Incorporated, Nasdaq, Lyft, Stock Analysis, May 2025. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Introduction. Lyft Incorporated, Nasdaq, Lyft, is a prominent player in the U.S. ride-hailing industry, offering services that include rideshare, bikes, and scooters through its app. As of May 2025, Lyft's stock is trading at approximately $16.10 per share. This analysis delves into Lyft's recent financial performance, strategic initiatives, regulatory challenges, and market outlook to provide a comprehensive understanding of its investment potential. Financial performance. In the first quarter of 2025, Lyft reported revenue of $1.5 billion, marking a 14% increase year-over-year. The company achieved a net income of $2.6 million, compared to a net loss of $31.5 million in Q1 2024. Adjusted EBITDA reached $106.5 million, with a margin of 2.6% of gross bookings. Free cash flow for the trailing 12 months was approximately $920 million, a significant improvement from negative free cash flow in previous years. Gross bookings totaled $4.2 billion, up 13% year-over-year, and rides grew by 16% to 218.4 million, setting a new quarterly record. Despite missing analyst expectations for earnings per share, Lyft's strong revenue growth and profitability indicate a positive trajectory. The company's performance underscores its ability to generate cash flow and expand its user base, positioning it well for future growth. Strategic initiatives. Lyft's strategic focus includes expanding its service offerings and entering new markets. The company plans to launch approximately 1,000 Mobileye-powered robotaxis in Dallas by 2026, in collaboration with Marubeni. This initiative reflects Lyft's commitment to integrating autonomous vehicles into its fleet, potentially reducing operational costs and enhancing service efficiency. Additionally, Lyft has been expanding its advertising business, which is expected to reach $400 million in gross bookings by 2027, up from the projected $50 million for 2024. The company integrates advertisements within its app, in-car tablets, and on digital displays, primarily attracting the retail and hospitality sectors. Lyft is also focusing on international expansion, with plans to acquire Freenow, a European ride-hailing company. This acquisition aims to broaden Lyft's total addressable market and enhance its international operations. Regulatory challenges. Lyft faces regulatory scrutiny, particularly concerning driver compensation practices. In January 2025, the Federal Trade Commission, FTC, launched an investigation into Uber and Lyft for alleged collusion to suppress driver pay in New York City. The probe examines whether the companies reduced driver earnings through coordinated actions, potentially violating antitrust laws. Both companies deny any wrongdoing and assert compliance with city regulations. The outcome of this investigation could have implications for Lyft's operations and reputation. Market outlook: the online travel and ride-hailing industry faces a challenging environment in 2025, with analysts expressing caution. A consensus rating of reduce has been assigned to Lyft by several brokerages, with price targets suggesting limited upside from the current stock price. Factors contributing to this cautious outlook include competitive pressures, regulatory challenges, and economic uncertainties. However, Lyft's strategic initiatives, such as expanding its advertising business, integrating autonomous vehicles, and entering new markets, could provide avenues for growth. The company's ability to execute these strategies effectively will be crucial in determining its future performance. Risks and considerations: investors should be aware of several risks associated with Lyft's operations. Regulatory scrutiny, ongoing investigations, and potential regulatory actions could impact Lyft's business operations and financial performance. Competitive pressures: intense competition from other ride-hailing companies, such as Uber, could affect Lyft's market share and profitability. Economic sensitivity: economic downturns or changes in consumer behavior could influence demand for Lyft's services. Execution risks: the successful implementation of strategic initiatives, including autonomous vehicle integration and international expansion, carries inherent risks. Conclusion: Lyft Incorporated has demonstrated strong financial performance, with record growth in rides and gross bookings. The company's strategic initiatives position it for potential growth, though regulatory challenges and competitive pressures present risks. Investors should consider these factors and conduct thorough research before making investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Western Asset Mortgage Capital Corporation, WMC, Comprehensive Stock Analysis Note: this analysis is for informational purposes only and does not constitute financial advice. Investors should conduct their own research and consult with a licensed financial advisor before making investment decisions. Company overview: Western Asset Mortgage Capital Corporation, WMC, is a real estate investment trust, REIT, that primarily invests in residential mortgage-backed securities, RMBS, including both agency and non-agency RMBS. The company focuses on generating income through the acquisition and management of a diversified portfolio of mortgage assets. WMC is managed by Western Asset Management Company, a subsidiary of Legg Mason, which provides investment advisory services to the company. Recent financial performance: as of May 2025, WMC's stock is trading at approximately $9.18 per share. The company has experienced significant volatility in its stock price over the past year, with a 52-week range between $7.82 and $11.64. In the most recent quarter, WMC reported a net income of $1.25 per share, a substantial improvement from the previous quarter's loss of $14.73 per share. This turnaround is attributed to strategic portfolio adjustments and improved market conditions for RMBS. Barchart.com revenue for the quarter was approximately $21.97 million, a decline from $74.20 million in the same quarter of the previous year. This decrease is primarily due to a reduction in the size of the company's investment portfolio and lower yields on mortgage assets. Despite the revenue decline, the company has maintained a positive outlook for the upcoming quarters, projecting revenue growth as market conditions stabilize. Value investing dividend policy and yield: WMC has historically been known for its attractive dividend yields. As of May 2025, the company's dividend yield stands at 10.24%, significantly higher than the industry average. However, it's important to note that dividend yields can be indicative of potential risks, especially if they are unsustainable. Investors should assess the company's ability to generate consistent earnings and cash flow to support its dividend payouts. Company's market cap strategic initiatives: in response to market challenges, WMC has undertaken several strategic initiatives to enhance shareholder value. Portfolio optimization: the company has restructured its investment portfolio to focus on higher quality RMBS, aiming to reduce credit risk and improve yield stability. Cost management: WMC has implemented cost-cutting measures to improve operational efficiency, including streamlining administrative functions and renegotiating service contracts. Capital management. The company has explored opportunities to raise capital through equity offerings and debt issuance to strengthen its balance sheet and support future growth initiatives. Market outlook. The outlook for WMC is influenced by several factors. Interest rates. Fluctuations in interest rates can impact the value of RMBS and the company's cost of capital. Housing market conditions. The performance of the housing market affects the underlying assets of RMBS and, consequently, WMC's investment portfolio. Regulatory environment. Changes in regulations governing mortgage markets and rates can affect the company's operations and profitability. Analysts have a mixed outlook on WMC, with some projecting potential upside based on the company's strategic initiatives and market conditions, while others express caution due to the inherent risks associated with the mortgage sector. Risks and considerations. Investors should consider the following risks. Credit risk. Exposure to non-agency RMBS introduces credit risk, particularly if underlying borrowers default on their obligations. Market volatility. Fluctuations in the financial markets can affect the value of mortgage assets and the company's stock price. Liquidity risk. The ability to buy or sell assets without causing significant price changes may be limited, especially during periods of market stress. Regulatory risk. Changes in laws and regulations affecting rates and mortgage markets can impact WMC's operations and financial performance. Conclusion. Western Asset Mortgage Capital Corporation presents a compelling opportunity for income-focused investors seeking exposure to the mortgage sector. While the company offers attractive dividend yields, potential investors should carefully evaluate the associated risks and consider the company's ability to sustain its dividend payouts in the face of market challenges. Conducting thorough due diligence and consulting with financial advisors is recommended before making investment decisions. Macro trends.